A market form refers to the mode in which the firms respond and interact with each other. It is the environment in which the firms make their pricing and output decisions. The market forms are usually studied with respect to the degree of competition prevailing in the market. There are perfectly and imperfectly competitive markets operating in the economic world. A perfectly competitive market is the extreme case where the market structure is absolutely impersonal and the invisible hand leads to the allocation of resources unhindered. There is large number of firms behaving in a completely competitive manner. There is no rivalry among the suppliers in the market, and buyers do not recognize their competitiveness vis-a-vis another. Thus, in this sense, perfect competition describes a market in which there is a complete absence of direct competition among economic agents. However, it is more of a theoretical model with only close approximations in reality. Nevertheless, it forms the benchmark for studying the market forms and provides some useful insights in the economic world. In order to study the pricing and output decisions of a perfectly competitive market, it is important to look at the basic assumptions of this market and understand the environment in which it functions.
After studying this module, you shall be able to understand the structure of a perfectly competitive market, know about the assumptions on which this model is based. You would also be able to know how to evaluate the profit maximizing output level for a firm using total and marginal revenue and cost curves. A market form refers to the environment in which the firms interact with each other. The pricing and output decisions of a firm depend on the market form in which it is operating. The markets are broadly divided into two forms, that is, perfectly competitive markets and imperfectly competitive markets. Perfect competition is an extreme case of market forms where the market structure is absolutely impersonal and the invisible hand leads to the allocation of resources unhindered. However, it is more of a theoretical model with only close approximations in reality. Nevertheless, it provides some useful insights in the economic world. Every market form has a set of working assumptions. There are three basic assumptions of a perfectly competitive market structure. It is assumed that there are large number of buyers and sellers existing in the market. The product being sold in the market is assumed to be homogeneous across the firms. Moreover, free entry and exit of firms is assumed in this market. The assumptions are taken up in detail in the following slides. Let's look at the first assumption. The large number of buyers and sellers imply that each seller sells only a fraction of total market supply, and each buyer demands only a fraction of total output. Therefore, no single consumer or producer can influence the market price of the product. The market price is determined by the free play of demand and supply forces and is independent of firms' and consumers' behavior. Thus, they are price takers in such a setup. The second assumption says that the product sold by the firms is homogeneous in physical as well as technical aspects. This assumption makes sure that no firm can charge a higher price than the market price without losing its market share to other firms. This holds true as there are no quality differences in the product of the firms. It reinforces the point that the firms in a competitive market are price takers. Free entry and exit of firms and consumers is assumed in a perfectly competitive market. The firms respond to the monetary incentives, which means that new firms enter the market if the existing firms are making exorbitant profits, diluting the profits of incumbent firms in the process. Similarly, the firms are free to exit the industry in case of losses, thereby increasing the market share of the remaining firms. There are no special costs attached if a firm enters the industry or exits if it is not making any profit. Free entry and exit of firms thereby implies that in the long run, all firms in the industry are making exactly zero economic profits. This assumption is important for the competition to be effective. It means that the consumers can easily switch to a rival firm if the current supplier raises the price. There are no copyright and patents to obstruct the firms from entering the market.
Let us now discuss in detail these three assumptions of perfect competition. Large number of buyers and sellers. In a perfectly competitive market, there are large number of buyers and sellers. Every consumer demands only a small fraction of the market output, and similarly, every individual firm produces a negligible fraction of market supply. Therefore, no single producer or consumer can make an impact on the market price prevailing in the market. The market price in a perfectly competitive market is determined by the interaction of market demand and market supply curves, and each firm takes that as market price as given. This assumption implies that the firms and the consumers in a perfectly competitive market are price takers. The firms and the consumers in such a market are independent and correctly believe that their decisions will not affect the market price. 3.2 Product homogeneity. In a perfectly competitive setup, each firm produces and sells a homogeneous product. The homogeneity aspect relates not only to the physical or technical characteristics of the product or commodity, but also to the services associated with the product and the environment in which the purchase is made. When the products of all the firms in a market are perfectly substitutable with one another, then no firm can raise the price above the market price without losing its market share to other firms. This reinforces the point that the firms in a competitive market are price takers. The agriculture products, copper, cotton, etc., could be apt examples of such goods. On the other hand, if the products are heterogeneous, then the consumers make their buying decisions depending on the quality of the products. As the goods are not perfectly substitutable, each firm has the opportunity to raise its price above that of its competitors without losing any of its sales. 3.3 Free entry and exit. In a perfectly competitive market, the firms are free to enter or leave the industry in response to the monetary incentives. It means that there are no special costs attached if a firm enters the industry or exits if it is not making any profit. Moreover, there are no hidden hurdles in terms of copyrights and patents obstructing new firms to enter the market. For example, the aircraft industry is not perfectly competitive as the entry requires immense investment in plant and equipment which has little or no resale value. An important implication of this assumption is that new firms enter the market if the existing firms are making exorbitant profits, diluting the profits of incumbent firms in the process. Similarly, the firms are free to exit the industry in case of losses, thereby increasing the market share and profits of the remaining firms. Free entry and exit of firms thereby implies that in the long run, all firms in the industry are making exactly zero economic profits. The assumption is important for the competition to be effective. It means that the consumers can easily switch to a rival firm if the current supplier raises the price.
Apart from the three assumptions discussed in the earlier slides, there are some more assumptions on which this form of market is based upon. There is no government intervention in such a market, implying that there are no taxes, subsidies, rationing, etc. Moreover, the factors of production are assumed to move freely from one firm to another and from one industry to another. The consumers and producers are assumed to have perfect knowledge about the present as well as the future conditions of the market. Though the assumptions of perfect competition are rigid and unlikely to be fulfilled in reality, however, moderate deviations from them do not undermine the usefulness of the model.
Let us now take two examples of perfect competition in real world. The markets of agriculture commodities are close approximations of a perfectly competitive market. The agriculture produce is more or less homogeneous among the producers, and each producer's supply accounts for only a small fraction of total output. A single potato seller cannot individually influence the market price of potatoes as his produce is approximately homogeneous to other producers. If he charges a price higher than the market price, then none of the consumers will buy from him. Also, the barriers of entry and exit in terms of movement of resources are practically non-existent. Another example for perfectly competitive structure could be the stock market. The market price of a particular stock is determined by the free play of its demand and supply in the market. Individual buyers and sellers are too small to influence the price and are thus the price takers. Moreover, all the units of the stock are identical or homogeneous. The resources are perfectly mobile, as the stocks can be traded as frequently as desired. The assumption of perfect knowledge is also met as the information on share market is easily available.
The market of agricultural products is a close approximation to a perfectly competitive market, as the output is pretty much homogeneous across the sellers and each producer produces only a small fraction of total output. Also, the barriers of entry and exit in terms of movement of resources are practically non-existent. Similarly, share market also resembles the setup of perfect competition. All units of stock are homogeneous and the market price is determined by the free play of demand and supply forces. The assumption of perfect knowledge is also met as the information on share market is easily available.
The output determination model of a perfectly competitive firm requires a close understanding of the goals of the firm as well as the information available with it. Any business enterprise has the knowledge of its cost structure, but minimizing the cost is not the predominant objective of the firm. In the economic analysis, profit maximization is usually taken to be the objective of a firm. Profit is equal to revenue minus cost. Therefore, in addition to the cost structure, the firm needs to make an estimation of the revenue which is realized by selling different quantities of the output. The quantity sold multiplied by the price charged for each unit by the firm is the revenue earned by the firm. That is, revenue is equal to price into quantity. Therefore, the cost and demand conditions jointly determine the profits of the firm, which upon maximizing gives the equilibrium output level. The question of whether firms actually seek to maximize profit has been controversial. Profit maximization as an objective of the firm is discussed in further subsections with respect to the size of firm, control of firm and its structure.
The profit maximization is the ultimate goal of any business enterprise. Profit of the firm is defined as the excess of revenue over cost. Therefore, in addition to the cost structure, the firm needs to make an estimation of the revenue which is realized by selling different quantities of the output. The quantities sold multiplied by the price charged for each unit is the revenue earned by the firm. Thus, the cost and demand conditions jointly determine the profits of the firm, which upon maximizing give us the equilibrium output level.
Large sized versus small size firms oblique manager controlled versus owner controlled firm. Small firms are usually owner managed and profit maximization appears to be a plausible objective as the profits of any firm are pocketed by the owner. However, in the case of large corporation, there is a separation of ownership and management. When a manager has the power to take day-to-day decisions of the corporation, then profit maximization may not be the goal, as these managers are salaried personnel having no direct effect of profits on their salary, except the case when salaries are in accordance to profits of the firm. It has been suggested by William Baumol that managers of large corporations aim at maximizing sales instead of profits. Other goals which could be pursued by the managers of the large firms could be revenue maximization, revenue growth, higher payments of dividends to the shareholders, maximize short-run profits at the expense of long-run profits. The above argument suggests that profit maximization is not the predominant objective of large manager-controlled firms, but such deviations by managers from the profit maximizing objective could not continue for long. There are several reasons why such deviation of goal is limited. The future job prospects of a manager essentially depend on how profitably the current firm is run by the manager. Therefore, they eventually resort to profit maximization as their goal. If a large firm deviates from profit maximization, then eventually its share prices will follow a downward trend. A depressed share price could lead to replacement of management team. Usually, the salaries of managers are tied up with the profits of the firm. In such cases, the managers have a fair incentive to follow profit maximization principle. Thus, it could be said that in any case, the firms that come close to maximizing profits are likely to survive in the long run. Therefore, the working assumption of profit maximization seems quite reasonable. Cooperatives. A cooperative is an association of people or businesses owned and managed by its members for mutual benefit. For example, a food cooperative is set up to provide food to its members at the lowest possible price. Such enterprises do not follow profit maximization as their major objective. Their purpose is to provide the best service to its members at the minimum cost.
A firm decides the equilibrium level of output using the profit maximization principle. It can be studied using the total curves of the firm. Total revenue is denoted by TR and total cost of the firm is denoted by TC. Both are functions of output level. The profit is defined as the excess of revenue over cost, and thus it is maximum when the distance between TR and TC is maximum. From the output level 0 to Q0, the profits are negative as the total cost curve is above the total revenue curve. It implies that the revenues are not sufficient to cover the fixed and the variable costs of production. As the quantity sold increases, the total revenue increases more rapidly than the total costs, and the profits become positive. At the output level Q star, the difference between TR and TC is maximum, and it is where the profits are maximized. However, if the firm sells more than Q star, the profits start to fall and eventually become negative after the output level Q1. The bold red curve is the profit function. It is negative at the initial output levels and then starts to increase and reaches the maximum level at Q star, after which it falls off.
The profit maximization behavior of the firm can also be understood with the help of marginal curves. Marginal revenue, that is MR, is the change in the revenue resulting from 1 unit increase in the output level sold. It is per unit change in the total revenue of the firm and is therefore the slope of the total revenue curve. In figure, the marginal revenue MR at point A would be the slope of the dotted line. Marginal cost, that is MC, is the per unit change in the cost resulting from 1 unit increase in the output level produced. It can be read as the slope of the TC or the total cost curve.
The profit maximizing condition of a firm can be studied using the marginal curves as well. The rule for profit maximization for any firm is that the marginal revenue should be equal to the marginal cost, whether the firm is competitive or not. As we know that the marginal cost is a U-shaped curve and thus intersects the marginal revenue curve at 2 points X and Y in the given figure. However, only one of these points is profit maximizing. The firm should not stop the production at Q1, as increasing the output level will add more to the revenues than to the costs, thus increasing the profits. But as the firm reaches output level Q2, it has no further incentive to increase the output. If the output increased any further, the firm will add more to the costs than to the revenue, thus reducing the profit level. Hence, the profit maximizing output level is given by point Y and not by point X.
Using calculus, the profit maximization condition can be derived as follows. Pi Q is equal to TRQ minus TCQ. D pi by dq is equal to dtr by dq minus dtc by dq is equal to 0. That is, according to first order condition, MR is equal to MC, and the second order condition is d2tr by dq2 minus d2tc by dq2 less than 0. That is, slope of MR curve is less than slope of MC curve. Thus, both the conditions for profit maximization are derived algebraically.